Mahantesh, good morning. Many thanks for joining in. Appreciate your time. That's the key question that I've been thinking about for the last 3 days with Bajaj, Hero, as well as TVS dropping to near about their 52-week lows, while the monthly sales numbers for autos by and large seem to be okay. Now, what should an average investor do when he's looking at this pack? Let's start off with the two-wheelers first.
So basically the average investor shouldn't really panic because these are finally good stocks. Automobile stocks generally are high ROE, ROC generating companies, and they also generate a huge amount of free cash flow. So within that auto space, two-wheeler space also have the same characteristic. In fact, the ROCs are far stronger, and the kind of cash balances that they sit on is far too large. So therefore, whenever the stocks react downwards, it's the time to buy for retail investors. That's what I would generally advise, and general investors as well.
What do you make of this commentary though, Mahantesh? Would you believe that over the next couple of, or maybe the next, not couple of years, but the next 18 months, because of this competition that Bajaj Auto spoke about, their margins could drop down, and as a result, maybe Hero's margins and maybe TVS margins could also stay under pressure?
There is a lot of buzz about this competitive pressure building up, and there is some evidence of that has been seen in the first quarter results in terms of margins being compressed. But how long or how sustainable this price war and competitive pressure remains is something we are not sure about. We do think that this will be for some period of time, but won't be for extended duration, and therefore there is value that can accrue into the stocks. The competitive pressure may drop the margins for 1 or 2 quarters, but not really more.
Okay, interesting. What about the non-two-wheeler space as well, Mahantesh? Because we've seen tractor companies fly through, zoom through in first quarter, but if the Escort's commentary was to be believed, they'd mentioned that while the first quarter sales numbers will look very, very buoyant, the average for the year was probably just about double digits or thereabouts. Therefore, which means that there could be some downticks in growth numbers in the quarters ahead. Let's start off with the tractor companies. How do you play them? I mean, is there value out there, or would you believe that being the third or the fourth year of an upcycle, we might be nearing, say, the top of sorts?
So tractor industry is known to be cyclical, and therefore what you have correctly identified in terms of the sales being on an upcycle right now would naturally mean that the down cycle is going to come. This down cycle probably will be seen after this monsoon season and festival season is over, and therefore the prospects for tractor companies ahead in terms of volume growth doesn't look all that great. But having said that, what should also be remembered here is that we have gradually infrastructure sectors picking up. Much of the tractor sales, while they go for core agriculture use, some of the tractors are also deployed for infrastructure activity, construction sites, etc. And therefore there could be some solace available in terms of volumes for tractor companies. So how we play these companies is that so long as they're delivering steady state margins, volume shouldn't be a concern, and therefore stocks should maintain their valuation levels being steady ahead, and therefore the stock should steadily rise.
Mahantesh, I was looking at the YTD performance of the auto pack, and what may come as a surprise to a lot of viewers, save for 4 names, which include Mahindra and Mahindra amongst others. There are very few which have given returns. So there is Apollo, MRF, Exide and M&M are the only 4 stocks YTD in the auto space that have given positive returns. What's not done well, Mahantesh, is on a YTD or a 1-year basis are the Tamo twins. Now, is the pain in the price, or will it remain in the price for a really long period of time, and therefore we could see a time correction in addition to the price correction that we've already seen in Tata Motors? What is your best thought?
So, see, the automobile companies have not given good returns. So, reason number one is, which you didn't identify while you identified the others, is that Maruti, which had reached of almost 10,000 in terms of its stock price level, really didn't perform thereafter because the valuation looked overbloated at point in time. But coming to your specific question on Tata Motors, there is a concern about the overall JLR business pie of the Tata Motor Group. And there we are seeing high capex levels. They are restructuring their balance sheet. They are taking huge amount of depreciation charge. And as we go forward, the guidance that is being given for JLR is that it will be a business which will not generate free cash flows. These are not good signs for any business, let alone JLR. So we think that as time progresses, unless this whole capex phenomena is relegated to something which is manageable levels, we will not see the stock really perform.
Okay, Mahantesh, really appreciate you joining. Would love to chat more, but just slightly running short of time. But thanks so much for joining in today and giving us your thoughts.